All right, everyone, welcome aboard. Thank you for joining today's webinar. Today is 12th of October 2024, and it is Saturday. On behalf of NCM Group, NCM Financials Dubai, NCM Institute, and NURCM Academy, welcome aboard. Thanks for participation. This is Mahsin Khan. I'm the Head of Learning and Education at the NCM. And I do understand today is a weekend. And my major responsibility today is to make sure and ensure that you get your time's worth. I do understand it's time to spend with family, go out, have fun, etc. Right? So before we get started, let's get to know each other if it's okay. Please just write in the chat box, what's your name, what do you do, and where are you watching this webinar from on Zoom? Can you share that with me? Me personally, I'm right now in Kuwait. Welcome, Mr. Nasser. Welcome. Great to have you. What about the others? Great, Mr. Faraz. Thank you. Miss Shin, thank you so much. Thanks for writing back to us. Now, the official presentation today would hardly take 45 minutes. It's just 45 minutes. But if you want to learn something really cool, amazing, something additional, it could take more than an hour. So can you please tell me in the chat box, do you want me to proceed formally as per company's templates and provided presentation, or you want to learn more valuable and cool stuff that can help you with your gold trading? Thanks, Mr. Saqib. Great to hear. All right, 1 hour is cool. Great. All right, so I believe what I understand now, it's okay to stretch the presentation. So today's webinar is about mechanical trading strategies for gold. So please make sure you have pen and paper. This session is being recorded and it will be available at NURCM Academy official YouTube channel. And you can even contact your account manager to provide you with the video copy for future references if you want to revise it. And the cool part is, once the presentation is over, I'll announce the cool part at the end of the presentation. Now, the first 10-15 minutes are going to be a little bit theoretical. They're going to be a little bit boring, and then we'll move into the technical part of the presentation. All right, so let's start. I'm going to share the PowerPoint presentation with you. Just confirm with me if you can see the PowerPoint on your screens. Can you see that? That's the topic for today. This is the topic: simplified mechanical trading strategies for gold. Everyone able to see that? Great. Let's proceed. First of all, a disclaimer. A quick disclaimer before we proceed. Financial trading online is just like any other business. It is very well rewarding with disciplined practice. If you learned a strategy or method, make sure you have done enough practice on it. But opposite also true. Financial trading is also risky. Please do not invest or trade with money you cannot afford to lose. Do not invest money from your savings, your school, children's education fees, medication, car payments, mortgage payments. Don't risk money that you need in hard times. Okay, just go with money that you don't need in urgency. Just a quick disclaimer. For further disclaimer details, you can visit even our website. So these are our topics for today. First of all, we're going to talk about what are the international financial markets, how many type of financial markets really exist. We're going to talk about role of a regulated broker, because no matter how you become good at trading later on after the session, or even if you have a prior experience, this webinar is for people with intermediate experience. It is very important to understand the nature of the financial brokerage that you want to trade with. Are they regulated, fully licensed? So we're going to talk there. Then we're going to talk about what's the difference between the regulated and non-regulated broker. What are the risks that are there? Then we'll talk about what are type of strategies. This is where the technical part will begin. It requires that you do have a MetaTrader 5 installed on your trading device, whether it's a smartphone or a laptop. Okay. And we'll talk what are mechanical trading strategies used by retail trading professionals. What are retail trading professionals? We'll define that for you. Then we'll talk about money management, risk management. I'm going to give you some important tips when we get to the strategies or techniques part. I'm going to give you some important tips that will help you even gain some confidence when it comes to your trading. So let's go with the theoretical part first. This is the official disclaimer. I'll just pause for 5 seconds. Take your time to read it. So let's pause for a few seconds only. We've already discussed verbally. So here we go. Now, there are 5 or 7 main kind of financial markets. The first markets everybody's familiar with is forex market. The word forex, it stands for foreign exchange. These are type of international markets online where the currencies of leading and non-leading countries are traded. Then you've got energy markets in which you've got the West Texas Industrial Oil, sometimes also known as the US oil, natural gas. Then you have something called precious metals market. Precious metals markets are the markets where precious metals are traded. Things like gold, silver, copper, platinum, and palladium. Gold is everyone's favorite. The reason being is gold is quite volatile. It moves quite fast. It's very sensitive to geopolitical tensions and escalations. Then, sorry, that's a repetition of energy markets. Then you've got something called index markets. Index markets where most of often people trade the S&P 500 CFDs, NASDAQ, which is a combination of 100 multi-billion dollar leading tech companies in the US. Then you've got Dow Jones. The last markets are equity markets. Equity markets are the type of financial markets where shares of companies are traded. In our case, we do have globally leading US companies available platform. So that's just a basic thing about it. Now, role of a regulated broker. It is often encouraged. We've been seeing nowadays, there's a lot of social media ads, advertisements going on. People are investing their money, they're trading their money. If they're successful, they're profitable. And when it comes to withdrawing their funds, the email that they were being contacted with, the telephone number they were communicating on, whether it was a WhatsApp or an international number, the people or these entities stop responding. It is very, very important for you, if you understand trading quite well, or when it comes to any investment schemes, make sure of few points. The first point is try your best to go with a trading account with an entity that is within your country where you're based. They have a physical presence and you should be able to visit them. And when you visit, the customer service, the sales team, the training wing, they should all be accessible for you, and you should be open to go for your queries. It's okay, the world is now fully online. You can ask questions, you can inquire through emails, live chat features on the website. But if you have a physical office available next to you, that's much better. Now we will share the address as well. It's also there. Now, how can you how can you know if the CFD broker that you want to trade with it's regulated or no? There are 2 to 3 ways. The first way, visit the financial brokerage company's website. So first point, go to the broker's website, check the About Us section. The business license, registration number should be there transparently, and it should mention what is the regulator's license issued to that entity. First thing is visit the website. Second thing, go to About Us. And the third important point is visiting the website footer. At the bottom of footer, there should be the business license details. Now, NCM Financials, this session is being hosted for NCM Financials. We'll just have a quick glimpse on their website. I'm going to try to share the screen. Just bear with me, please. Let me know if you can see the screen as well. Can you see the screen, please? This is the website of ncmfinancials.com. Okay. And let's check it out. Let's try to scroll down. Let's go to the website's footer. Here. Now, NCM Global, we have offices globally. Approximately, we've got office in United Arab Emirates. Under ESCA, we've got category 1 license there, and this is the registration number. In Kuwait, NCM is regulated by Capital Markets Authority of Kuwait. We've got a regulated entity in Dubai as well. We've got in Jordan, and we've got in Malaysia. Okay. Now, all the regulated financial brokerages, they are governed by the local authorities where they are based. The local authorities, they audit them, they check them, they keep on doing regular checkups to make sure that everything is going smoothly and no unethical activities are being practiced. So it's better to always go for a trading account with a local CFD broker that is not only licensed, but is under the umbrella of a leading regulation wing, such as in Dubai, you've got ESCA. All right. So this is just small tip for you. Now, there's another thing, another reason. Any financially regulated broker, it's mandatory for them to have 2 bank accounts. And I'll explain the purpose why. Let's go to the whiteboard. I'll explain you the reason. Now, we've got a regulator. This top here is the regulator. Then we've got the CFD broker. Oops. This is the regulator. We'll just say R. This is the broker. Okay. Now the regulation body, they enforce that the broker must have 2 bank accounts. Each and every broker must have 2 bank accounts. The first bank account is the CFD broker's own bank account that is used by the brokerage firm to cover their expenses like utility bills, rentals, employee salaries, their earnings, etc. The client's funds, they should be segregated. The client's funds are always kept segregated with the regulated broker, so that in case if a catastrophe was supposed to happen, the client funds are always kept intact. This is the advantage of trading with a regulated broker. So I hope this part is clear. If this part is clear, just mention in the chat box that this part is clear, and we are going to move further to the main part. So we've discussed so far importance of a regulated broker. In a non-regulated broker, the funds of the clients are not segregated. They can be abused, they can be misused. A brokerage can collapse or close in any time. And if something happens, you may not be able to reach them or even go for legal proceedings. So try to avoid non-regulated brokers and never ever fall for fishy traps where they're offering you dramatic or crazy, unrealistic returns. Thank you for confirming, Mr. Faras. So we've discussed small parts. These are the locations of the NCM group. The videos will be shared with you. So let's read this quickly. Regulated brokers follow government rules. This means your funds are usually held securely, and if there's a dispute resolution process, if something goes wrong, it can be managed. Unregulated brokers have no such oversight, putting your money and fair treatment at risk. So that's it so far. Excuse me for coughing. Now, how many types of trading strategies are there? The first kind of trading strategy is called manual trading strategies, in which a trader or an individual executes a trading order on discretion. In manual trading, you require in-depth knowledge of financial markets. You require to know what is the average daily percentage movement of the specific instrument like gold, oil, euro, dollar, pound, dollar that you're going to trade. Okay, so manual trading is fully discretionary. Now, there's a difference between mechanical and automated trading strategy. We're going to talk about that. Most people, they confuse themselves between the mechanical and automated trading strategies. In an automated trading strategy, there is something called on a MetaTrader 5 trading platform that we offer. The MetaTrader 5 trading platform that we offer is fully transparent. There is no inactivity fees. There are no hidden charges. There are no monthly charges on the trading platform. You can access it for demo accounts, live accounts. It's very user-free and easy to use. Now, automated trading strategies are also known as robot trading, but in the world of MetaTrader 5, we call these expert advisors. Now, expert advisors, there is a predefined parameters, there's a predefined strategy mentioned inside them, and the robot will execute buying and selling trades with stop losses or take profits as per given parameters. Expert advisors are also available in the MQL5 markets. If you download the MetaTrader 5 trading platform and go to the markets section, I'll show you where. You can even go through some robots there. You have to do your own due diligence. We are not giving any financial advice. It's just our independent opinion. Okay, you can go through that. But what are mechanical trading strategies? Because there are so many trading methods nowadays available on the social media, on YouTube, and other platforms. Mechanical trading strategy is a trading strategy. Now, here's something that you can write down. Okay, if you want to write it down, go ahead. Mechanical trading strategies are type of trading strategies that are based on technical indicators. A trader uses mechanical trading strategy to execute a trading decision based on technical indicators. And what are technical indicators? The difficult definition of a technical indicator is it is a visual display of a mathematical formula. Okay, that's the difficult definition. It's a visual display of a mathematical formula. An easy definition for you is a technical indicator is a built-in tool inside the trading platform. A technical indicator helps a trader in understanding and identifying what is the market trend, if the markets are moving upwards, or if the markets are moving downwards, or they are in a sideways trading range. A technical indicator can also be used for entries and exits. Clear? Do you want me to repeat it? Do you want to write it down, or is it okay? I'm more of an interactive person. It's for me, it's not only about writing and just communicating. I like people to interact. Clear, great. We've got 2 people confirming it's clear. All right, now let's go back. So that's what a mechanical trading strategy is. Traders make decisions based on indicators. The 4th type of trading strategy, thanks, Ms. Rian. I hope I'm pronouncing your name well. There are other trading strategies as well, which are used by institutions. These are based on price actions, smart money concepts, Wyckoff theory, Elliott wave, etc. But these are not part of our topic today. We will cover these topics on monthly basis, probably in our physical premises in our academy. Now you have to understand there are 2 types of traders. There are retail traders and there are institutional traders. Retail traders are individuals like us who are trading with small capital sizes, starting from 500 or 100 until probably $100,000. That's what a retail trader is. Retail traders do not really have a severe or any kind of high impact within the markets. Institutional traders are the market makers. They are the market movers. They are the people who are injecting cash, who are injecting liquidity inside the market so that markets fluctuate. Who are the institutional traders? These are number one, central banks. You've got state banks. You've got private banks. You've got investment brokers. You've got investment firms as well. These are the institutional traders. Now, so let's go. Do you want an easy strategy or you want something difficult? You want something complex? You want something easy? Great. Okay. I'll try to give you 3 strategies. Let's go for the first one. Both. All right, great, great. No worries. So we'll take even notes. I'll write things down for you as well. Okay, I'll write the notes for you. First of all, what are the requirements? Let's write it down. Let us write it down. This is a trend trading strategies. This is a trend trading strategy. So we're going to go to the whiteboard. I'm going to give you an easy trend trading strategy. Now, keep in mind, we've got 3 price structures. The purpose of price structures is to understand if the markets are trending upwards, downwards, or they are stuck. Idea, then we'll go into the method. Let's have a brief idea and we'll go into the method later on. So here, this is called an up channel, ascending channel, bullish channel, or a buy channel. In an up channel, you've got higher highs, you've got higher low. I am sure you know about these, right? The up channel indicates that the buyers are in control. In an up channel, you will see a lot of green candles being formed. The buyers are in control. The fuel that the market needs to continue moving towards upward direction is fresh injection of cash. If new money or extra money is coming in, the markets will start pumping towards the upward direction. And when the traders remove their money from the market, from a trading instrument that you're trading, it can be a currency, precious metal, or an energy product. Once they start removing their money, you will see the red candles will increase in quantity and in sizes. There'll be aggressive sizes. So the market will take a downfall because people are pulling their money out because of any reason. It can be political reason. It can be due to any fear, or things have gotten too expensive. So you get consistent lower lows in a downtrend. You get consistent lower lows. In an uptrend, you get consistent higher highs. Higher high means each high that is formed, it is higher than the previous one. All right. Then you have a sideways channel, rectangle channel, box channel, parallelogram. There's so many words for it. There's no consistency and the market is stuck. There are no consistent higher highs. There's no consistent pattern. There are 2 definitions for a sideways trading range, and these definitions have a conflict. A sideways trading range is a trading range or a zone in which buyers and sellers have agreed to trade within a specified range. Or it is a zone, or it is a price structure in which the buyers and sellers, they're confused, they're scared, they don't know what direction they need to move to the markets. Or we can also say the buyers or sellers are all in a balance. That's why there's a consolidation. All right. So these are price structures. They are used for identifying only the direction, not for entry. So there's a question here. Since it's gold, then scalp strategy would, yes, sure. By the way, I love questions. I welcome questions. At the end of session, we're going to have a question and answer session. If you have any question, you can write it also in the chat box and I'll answer it for you. But if you want to come over the microphone, all right, you just have to go to the reactions sign. You have to go to the reactions button in Zoom. There's a raise hand option. Just raise your hand and I'll unmute you to ask your question as well. Okay, so we're going to answer all the questions. I won't end the session until your questions are answered. Okay, so now since we're going to learn the trend trading strategy, what are the drawbacks of the trend trading strategy. The drawbacks are if the market is not trending, it can give false signals and false entries. Now, a very important tip that I'm going to give you right now is you have to first learn how to trade the smallest lot size. And what is the smallest lot size? It's 0.01. 0.01. If it requires explanation, I'll explain it at the end of session. But this is called 1 micro lot. If you can learn how to master 1 micro lot, you can trade any lot size. So begin with a practice, a demo. Start with 1 micro lot. Check for 1.5, 2 weeks how it performs and how were your results. Then you can increase your lot size as per your risk tolerance. So let's go back to the whiteboard. Here, let's write the rules. Let's write the rules. Rules for trend trading strategy. If you are someone who is not that busy, if you're not that busy, you can use a 5-minute chart. If you're someone who is busy, then you can use a 15-minute chart. Don't switch back and forth. Do not switch back and forth. Online trading is just like any other business, but online trading is a part-time business. You don't really need 3, 4, 5 monitors. 1 monitor is more than enough. As a beginner, it's good to learn how to trade from your laptop or a PC, but mobile phone is okay. But if we have enough time, I will even discuss with you the mobile phone trading strategy as well. There's a different method, a decent method for mobile phone trading as well. If time persists, if we have enough time, I'll share that with you. So the chart, you need M5 for people who have enough time and M15 for people who are busy, for busy people. Lot size is 0.01 micro lot. So what are the technical indicators that you require? Technical indicators. You need 2 exponential moving averages. What are these moving averages? You need a 5 EMA and you need a 30 EMA. Okay. Now I'm going to teach you this. I'm just going to remove my watch as it's distracting with the table. Okay. These are some very basic rules. Now I'm going to switch towards the MetaTrader 5 trading platform. This is the MetaTrader 5 trading platform. This is how it looks like. I'll give you a very brief basic introduction of the MetaTrader 5 trading. Does everybody here know how to use the MetaTrader 5 platform? Everybody knows here how to use the MetaTrader 5 trading platform? I've got 2 yes. What about the other members? Okay, so I will not introduce or go to the basics of the MetaTrader 5 trading platform. It's totally fine. Charting on TV is good so that you can zoom out and get a better view of the market. Okay, so let's go and we'll go deep into the strategy. Okay, I'm going to get rid of the market watch, navigator, and tools. First of all, let's change the colors. Right click, go to the properties. Let's go to colors. We'll color bull candle to green, bear candle to red, bar up, bar down. We're going to keep it black. Okay, great. Now, let's insert the 2 moving averages. We go to insert indicators, trend, moving average. I'm going to put a 5 exponential moving average first. The thickness level is increased to level 3. I'm going to color it blue and hit the OK button. So I've got my 5 exponential moving average over here. All right. First, this is step number 1. Step number 2, insert indicators, trend, moving average, 30. I'll color this probably, you can choose the color as per your discretion. I'll color it purple. I'll hit the OK button. Okay, now let's get rid of the drawings, close. Now the next step, if you like this method, if you like this strategy, what you have to do is right click, templates, save template, save template. You can call this 5 and 30, save. So that next time, whenever you want to load this chart, you don't have to build from the scratch. I can just go here. That's, for example, this is a euro dollar chart. I can right click, go to templates, 5 and 30, and have it. Key tip, key important tip, trend trading strategies are good for most volatile or fast moving trading instruments. If you want to write this down, you can write it down. It's good for trading on gold. Trend trading strategies are good for gold. They're good for oil. They're good for NASDAQ, Dow Jones, and they are also good for the Japanese yen pairs. You've got USD JPY, you've got GBP JPY, you got CHF JPY, which is the Swiss franc against the Japanese yen. Now, see, of course, as a trading broker, we've got a lot of trading products. We've got more than 100 trading instruments available for you, for our clients to trade with. But as a beginner, or if you're someone who's getting hard time in the financial markets, just select and choose one trading product, master it, practice on it until you have a grip. Then you can go for other trading products later on, but do not switch back and forth. You have to be successful in trading. It's very simple. It's few simple disciplines practiced every trading day. Okay, few simple disciplines practiced trading day. Now I'm going to give you a method. I'm going to give you a strategy. It's very simple. Now we're going to go into the entry and exit criteria, evaluate them, and we'll also discuss how you can improve your results further. So let's switch back to the MetaTrader 5. We've discussed so far what are the best trading products that are available. Let me just quickly zoom out. This is a 5-minute chart. This is a 5-minute chart. Okay. I'll disable the auto scroll. Once you describe, here's the auto scroll button. This allows me to scroll the chart backwards. So I disabled it. Now the rules are very simple and very easy. Like I mentioned, this is a strategy that's used for trend trading. First, we'll talk about good stuff. How do you enter? When you see a 5 exponential moving average. So there are two ways to trade this. There's a conservative way and there is an aggressive way. Let's talk about the aggressive way and then I'll talk about the conservative way after that. Okay. Here you go. When you see a 5 exponential moving average crossing above the 30 exponential moving average, that is your trigger to buy. That is your trigger to buy. And when you see a 5 exponential moving average crossing below the 30 exponential moving average, that is your trigger to exit your buy and reverse your trade. All right. That's the simple way of entering. This is the aggressive way. Now I'm gonna zoom in a bit. I'm gonna zoom in a bit. Let's use this example here. Let's use this example. First thing, the first and most important thing, you can see here, the 5 exponential moving average is crossing above the 30 exponential moving average, right? You have to wait. Why do you have to wait? You need these moving averages to fan out. They need to fan out. They need to create a gap. Why? First of all, the crossover, the moving average cross, the intersection point, the junction point where they are merging together, that is an indication that the market is going to change its momentum. It's going to switch direction. Okay. The moving average cross, I am not saying crossover. The moving average cross is a place or it's an indication that the markets are going to switch direction. All right. So let the moving average cross. After the moving average, it goes into a junction here, and they fan out. You can hit the buy button. Okay, simple. This is a very easy method, simple classical method. You wait for it, then you hold that trade. You hold that trade until you see an opposite signal that is coming. Okay, this one's easy. This is an aggressive approach. You see crossover, you see a little bit of gap, you hit the buy button and you hold it, right? What's the aggressive method? What's the, conservative method? In conservative method, you need a crossover, then you need the moving averages to fan out. After the moving averages fan out, wait for at least 4 or 5 candles. Wait for at least, after fanning out, wait for 4 or 5 candles, 1, 2, 3, 4, and 5 candles. Okay, then go for a buy trade. Okay, some people use stop loss and some people don't use stop loss. The one who are trading with a small lot size, they won't use a stop loss. But if you really want to use a stop loss, where would it be? You have multiple choices here. Either below the 30 moving average, you can place your stop loss, or you can use the swing low, the previous swing low from where the market bounced towards the started to shift towards the upward direction. That's where you can put a stop loss. Remember a few moments ago when we were talking about price structures, what did we mention? If you have an uptrend, within the uptrend, you would see the quantity of green candles is more than the red candles. Can you see that? There are a lot of green candles as compared to the red candles. Even the bodies of green candles is more. How you can optimize your entry? Support and resistance is taught by each and every person over the internet when it comes to trading. If you use the knowledge of support and resistance, you can add accuracy to your trading. Let me show you and let me try to explain you on the whiteboard. Most of the time, the markets, they behave like table tennis. The ball has to come from point A to point B, and it has to go back to from point B to point A. Here, let's suppose this is point A, this is point B. The ball has to go from here to point B, and it has to come back down. Forex markets, the currency markets are usually cyclical markets or cyclical markets, however you want to pronounce it. Forex markets are cyclical, okay? But most often the equities, indices, or gold, things that are tangible, they are also cyclical, but most of the time they would break out in a range. They would break out from a range, and in long term, they always tend to go towards the upward direction, okay? Now, how to improve the crossover strategy? Try your best. Let the price, first of all, come near the support zone. Let it come near the support zone. And there are price action patterns. Most people who don't like using indicators, people who are price action traders, they don't like using mechanical trading strategies. Okay, they use a W. They buy above this W, put the stop loss below the W for buys, and at the resistance, they use M's. These are price action methods, and the stop losses would be above. I'm sure you've heard about these a couple of times and you know how to place your stop losses. But let here the price come at the support zone. And if you get a support here, from this area, your moving averages should start to form a cross like this. You'll get a decent accuracy. You'll get a decent accuracy from support areas when the moving averages, they make a bullish cross, the 5 and 30 exponential moving averages, the reward will be much better and you will get less signals, less false signals. Now let's go back to the MetaTrader 5 platform. Okay, now we'll look at the example of short selling. After that, we'll go for more strategies and more method. Okay, for example, you've got a moving average crossover here. Not all trades are going to be successful, but when they're successful, you'll get decent. Now you see, this is the sideways trading range. Here, let's take our entry. Here we've got 5 moving average going below the 30 exponential moving average. It tries to fan out around this area. It tries. Let's suppose it was a fan out. We took a short sell and maybe we placed our stop loss around this area. We got hit. So that's the drawback. This whole area was a stop loss hitting area. Now you can, it is always said that do not risk more than 2% of your trading account, right? But I beg to differ. My personal opinion is do not risk more than 0.5%, 0.5% of your trading account size. Why? The reason being is, I'll tell you the reason. First of all, if you're risking 2% on each trade, it means you can trade 50 times. If you risk 1%, you have an opportunity to trade 100 times. But if you want to be conservative, you want to be relaxed, you want to be in the trading business for long run, as a starter, as a beginner, or someone who has least amount of risk tolerance, because some people, they can take aggressive risk, some people can take low risk. Everyone's personality is different, right? But with 0.5% risk per trade, you get to enter 200 times in the market. And trust me, this is the game of probabilities. I'm going to share a very important table probably at the end of our webinar. I would recommend take a screenshot or use your phone to capture that image. Okay, that will show you even if you have a low winning edge in the financial markets, you can still be a winning trader. We'll talk about that later. So let's go back to our chart. So we've discussed that this was a sideways trading range. Probably 3 times, 4 times our stop losses were getting run. Then later on we get a sell cross here, and you can see that when we had a successful sell cross and it went down, it compensated for all the losses that you would have occurred in this bad sideways trading range. This is one of the most simplest mechanical trading strategies. We've got decent feedback from our past and former students and clients who've been using this. So you can use this on we are using just a daily chart here, but it's more about gold. Let's go back to the gold chart. I'm going to go to the 5 minutes chart here. We'll try to zoom out. You can see we've got a, by the way, some people use stop losses and some people, they would exit the trade at opposite cross. You can see multiple signals being formed here. I'm just going to color them blue. You've got a buy entry here, then you've got an exit here. You get exit, you take a stop loss, you reverse the trade, you take a buy, but you need the market to catch a trend. Here, the market catches a trend at this crossover, and here you got the short sell trade. This was a big winner. Then again, you get false signals. You get a short sell trade, you exit here, take a buy, you get short sell trade again here. Then you're getting whipsawed, getting consistently losses in a fixed or narrow range. This is called getting whipsawed. Later on, the market gets the decent bullish cross. It catches the trend, market goes upward, and here is something that works out quite pretty well. And here you would have exited with a decent winner. Okay, this is the classic 5 and 30 exponential moving average crossover. Do you have any questions so far in regards to this method? Now on the 15 minutes chart, if you use the 15 minutes chart, you'll get the crosses less often, but you'll get quite decent moves. You'll get quite decent moves. You can see here, we've got a bearish crossover it went quite well towards the downward direction. Here we had an up, down, we get whipsawed. But here when the market catches a trend from here, you can see this was a very decent enough winner and this buy. You have to test it. It's a trend trading strategy. It's not a sideways trading strategy, but the knowledge of support and resistance will get things done quite well. For example, we've got a support here. We've got a resistance area here. We've got a support here and around these areas. And you can see that around major or extreme levels, people try to aim for short sell trades and ignore the buy trades. So here the market goes down, it's a short sell. When it reaches this area, it was a decent buy. Okay, try to avoid the signals that are generated in the center of the trading range. Sometimes I get excited and I start to use a technical vocabulary. I want to keep things simple. I want to use an easy language. If I'm being difficult, please feel free to write to me in the chat box that you're being fast or you don't understand anything, okay? So here you can see the support that gave a decent crossover signal here of a buy, okay? This was taken out, but then we had another support around, we had another swing level around this area. You have a resistance that became a support, and here we got a decent buy cross and it worked out quite well. So this is one of the simplest mechanical trading strategies that is available. It's good for beginners and easy to execute. And let's have some feedback. If you have any questions, let me know and I'll give you something more easy and simpler than this one. Do you have any questions, everybody? Great. Shall we go for one more method? Shall we go for one more easier method? Let's see the questions. Is it possible to combine this with daily bias? Do you want to use it on the daily chart? Alex, can you please? Yes, you can do that. If you, by the way, if you want to be a swing trader, there's scalping, day trading, and swing trading. In scalping, you enter and exit quickly, right? I haven't given you scalp. By the way, this is not a scalping strategy. It's just a intra-day trading strategy. I'll get to the scalping part, okay? I'll give you a scalping strategy and scalping method as well. All right. Now, let me see the questions quickly. Yeah. If you want to be an intraday trader, it's fine to use it on 5 minutes or 15 minutes chart. But for swing trading, you can go on a higher time frame, like 1 hour, 4 hour chart. It's more than enough. Scalping is getting in and out in less than 5 minutes. Day trading is concluding and finalizing your trades within the span of 24 hours. Swing trading is holding your trades from hours, days to weeks. Position trading is holding trades for over 6 months or more. Okay. Now, I'm going to give you a scalping strategy very quickly. Okay. Scalping is risky. It's stressy. It requires attention. It requires focus. It requires decent money management, and it requires you to be on the chart most often. So for scalping strategy, please write it down because it's not part of our course today, but you can write it down. For scalping strategy, you need 3 exponential moving averages. You need a 25 exponential moving average, you need a 50 exponential moving average, and you need a 30 exponential moving average. So let us put them on the chart. Then we'll go to the easier trading strategy. All right. Who asked for scalping strategy, by the way? I hope I'm answering all your questions. All right, Alex. So we're going to go for a scalping strategy here. You need 3 indicators. You need, let's delete the objects. You need a 25 exponential moving average, and you need, here, I'm going to add it in front of you. Where is moving average? Okay, you need 25, 50, and 100. You're going to color this red. Okay. Then we're going to go for this one. We're going to color this 50. And 50 would be colored black. Okay. And go for the blue one. We're going to cover this 25. So it's a 3 exponential moving average system. I think you guys will like and enjoy this more. We can use it on a 1-minute chart as well. It can be used on a 1-minute chart. Now I'll give you some important tip again for this one. Let me go to the whiteboard. Now you've got 3 moving averages. Okay. These are your 3 moving averages. Now you have, this can be called just like Bollinger Bands. You can call this upper band, lower band, and the center band or a mid band. Let's bring them over. Okay, this space between them, I call it something called trading decision cloud. You will use these for your trading decisions. When you see the 25, 50, and 100 moving average crossover here, then they fan out. There's a decent distance. This is how you enter. Let me choose another color. The market is going up. When the market pulls into this cloud of moving averages, it touches the 25 exponential moving average and a green candle closes above the 25 moving average. Closes, it must close. This is your place to enter a buy trade, and your stop loss is going to be at your 50 moving average. This is where you're going to put a stop loss. Your risk to reward ratio, if the stop loss is 25 pips, points, whatever it is, your take profit should be at least 2 to 3 times. Okay, so if it's 25 pips stop loss, you're going to go for a 50 points take profit. If it's a 15-point stop loss or a 15 pip stop loss, you have to go for at least 30 pips take profit. You have to trade with at least 1 to 2 risk reward ratio. Do you know what does this mean? 1 to 2 risk reward ratio means that you need to be successful 36% of your time, 36% times. Like if you took 100 trades and you want to be profitable, at least 36 trades should be winner. You can even do the math. 64. Let's say I'm risking $1. Let's say each of my stop losses is $1. Okay. So I lost 64 trades. So I lost $64. But I'm winning $2 on each trade, and I want 36 trades. So 36 multiplied by 2 is what? 2 6 is 12 and 72 plus 72. So I am still profitable. That's the power of trading with 1 to 2 risk reward ratio. It's fast, it's decent, it's less headache. You hit your stop loss, it's fine. If you don't hit your stop loss, you're winner. It's totally good. Okay, so let's go back and I'll show you proper examples. So I hope everyone's enjoying. I hope you're not getting bored. Are you getting bored? Do you want me to continue? Great. Let's go back here. Let me zoom out. You can use this method can be used in a 5-minute chart and 1-minute chart as well. Let's go for a buy example. Here. Let's assume this is a proper crossover. This is a proper crossover. Okay. Let me grab the drawing tool. Let me get the drawing tool. Here. So the price goes up. It pulls back. It pulls back. Then there's a green candle close. It pulls back below the 25 moving average. It's above the 50 moving average. Here's your stop loss. Here's your entry. Go for 1 to 2 risk reward ratio. Try to go. I believe this did go almost around 1-to-2 risk reward ratio. At 1-to-1 risk reward ratio, you can put your stop loss to entry. So this was a kind of a decent trade. Okay. And again, if it goes down here, you might have hit a stop loss, but let's zoom out. We'll get a better idea when we here. It's a trend trading strategy. So this is your initial entry. Here you hit the stop loss. This is the entry at 200 moving average. This 50 moving average. This is the stop loss, right? It got hit. Now the 50 moving average is your backup plan. 50 moving average here. This is your backup plan. Okay, you lost here. You lost this trade. If the market comes down and even closes above the 50 moving average, it closed above, you can take an entry here, and below the 100 moving average, you keep your stop loss. You can see you've achieved your 1-to-2 risk reward ratio, and you got another trade here. You got another trade. It gets pulled back, closes. You got another buy entry. Here's a stop loss. 2 times you get hit. You get the target. Again, here you have market closed at the swing low below 200 moving average. You can keep your stop loss, and it goes up. You get your 1-to-2 risk reward ratio. It performs quite well in a trending environment, and it would hurt you in a sideways trading range. But when you see the moving averages, the 25 and 50 moving averages creating a crossover, stop trading, wait for clear crosses. So here we are no longer trading because there is no proper trend. The triple moving averages are telling you if the market has a valid crossover or no. And you can see here all the 3 moving averages within this zone, they did a crossover around this area, but the price went up, but it never came down. Okay, let's continue further. Let's look for some bearish examples from the past as well. It is an impressive strategy. It is an impressive method. You've got here as well. Here you got a sell trade. The price gets pulled back. It went up. Then it gave you here an entry. A price candle closes below the 50 moving average. At 200 moving average, you have your stop loss. You go for you enter here, you go for at least 1-to-2 risk reward ratio, and it did offer you that and did quite well. There are going to be, of course, good trades and bad trades, but just go through this. So you need only 3 exponential moving averages. When the markets are trending, they do quite well. You can see these examples clearly. Here, another example, we wanted a short selling trade. We never got it. Here's a sideways range. We know we have to avoid these, So I hope you liked and enjoyed this method as well. It's a scalping technique to get quickly in and out. Is it clear? Is it clear so far? This is just randomly, I accepted the request because someone asked for a scalping strategy. Use it at extreme support and resistances. It's also a trend trading scalping method that is quite efficient and useful. So let's see your questions. Let's see your questions here. Clear. Yes, it's 25, 50, 25, 50, and 100. 25, 50, and 100. Okay. All right. We're going to go for last method. This is the most easiest and simplest method. It can be used by anybody. You can even teach it to your close colleagues and family members and your friends. This is the most simplest one. All right. This is the last method I'll discuss today. Then we will go to our final slides and we'll end the presentation. This last method, it requires, let's get rid of the indicators. The last method, it requires an oscillator. We need insert indicators, oscillators. You need a MACD. The special and the secret sauce of the MACD is this. This is the secret tool. These are the secret parameters. You need a 55. Fast EMA should be 55 and the slow EMA should be 233. Main color, you can keep it anything you like. You want to keep it black, you can keep it black. You can want to keep it blue, up to you. keep the thickness to level 3 or 4 at least. I like to keep it level 4. The signal line, it should be transparent. It should be none. If you're a mobile phone, choose the color here of your background. The heart of this method, the heart of this indicator and this technique is the levels section. You must have a level 0 added. You click on add, a 0 level will be button. Hit the OK button. You've got MACD. This can be used on a 1-minute chart. It can be used on a 5-minute chart as well. This is the easiest thing you will ever find, and I can assure you, you won't find it over the internet as well. Okay, can I increase the thickness of the 0 line? Color black. Hit the OK button. Yeah. Okay. This is very, everybody knows this, right? These bars are called histograms in the MACD. These are called histograms. The method is really very simple. It's straightforward. When the MACD goes below the 0 line, when you see the market curling or the indicator curling below the 0 line, okay, this is an indication that the market's direction, momentum has shifted towards downward direction, and you can even enter a short sell trade here. You can take a short sell trade here. This is a trigger to short sell. And when the market curls and goes above the 0 line, this is a trigger to enter a buy trade. It's an indication that the market has shifted its momentum towards the upward direction. No strategy is an ideal strategy or a perfect strategy. The wins and losses are parts of this game. I'm just going to zoom out and you can see this is also a trend trading method, and you can see when we have a curl here shifting toward above 0 line, you can see how big it shot upwards. And when it had a curl below the 0 line, it was a late entry here. This is a late entry. It won't have given you decent amount of returns. Maybe you would have entered, you'd have taken a small loss, but later on it compensated for the loss that you may have incurred. Okay, so explore this. You can go through this method. We had an earlier short sell signal here as well, and it went quite decent. It was fine. Okay, you can explore this method. It's the simplest method. It can be used for dollar cost averaging as well. If you're trading with negative leverage, you've got decent moves. So this one's the most simplest one. It can be taught to anybody. If you use one micro lot, if you practice on one micro lot, this won't really hurt your trading account. So now let's go quickly towards our PowerPoints. We'll go to our slides. Give me a moment, please. This is the slide that I wanted you to take a screenshot of. Take a screenshot, take a picture. If you trade with 1-to-1 risk-reward ratio, the win rate that you require is 51%. If you trade with 1-to-2 risk-reward ratio, it's 34%. 1-to-3 risk-reward ratio, you need 26%. Many people, many successful retail traders, they discretionary trade with 1-to-2 or 1-to-3 risk-reward ratio. So I hope you enjoyed today's session, and these are our addresses. Now, if you have any question and answers, let's take your question and answers if you have any over the microphone or the chat box. Now, the best and cool thing, we have an offer. If you like our video and if you become a client with any of the NCM entities or any of our group offices, you can also request one-to-one trading sessions on Zoom. If you want to have more sessions with any instructor of ours, we've got multilingual instructors. I myself speak multiple languages. So I'm fluent in English, Arabic, Russian, Urdu, Punjabi, and Hindi. So, if you want even one-to-one sessions, that is also possible. You can request from the company, but the criteria is if you open an active trading account. So thank you so much for attending our webinar on this weekend. Really nice to have you. and it's totally fine if you miss the session. The recording is available. It will be available by tomorrow. You can ask your account manager for the recording of the video. They'll provide it to you. So if you have any questions, just feel free to raise your hand or chat in the or type in the chat box. I'll be glad to answer them for you. So any questions, people? Any questions for me? How was the session? How to determine the daily bias? Okay, to determine a daily bias, there are multiple methods, but if you see, let's suppose we covered a 5 and 30 exponential moving averages indicator, right? Let's suppose this is a gold chart. You go to your templates, you load, go to a 4-hour or a daily chart. Okay, let's go to the daily chart. Time frames, daily chart. Okay, moving average is a trend trading indicator. If the prices are above the moving average, it means the markets are bullish. Okay, so this is an easy mechanical shortcut of determining a daily bias. If the prices on the daily chart are above your moving averages, it means you are still in an uptrend. If the candles or the prices are below the moving averages, like in the past, it means the bias is towards the downward direction. There are many other methods available, but I am talking in perspective to the methods that were taught today. All right, I hope this is clear. Okay, there's a question. What time frames do I prefer? Time frames vary from person to person. If you're someone who can be active and available on the chart all the time, 5 minutes is okay. But if you're someone who is busy, you've got a busy life, you can stay with a 15 minutes chart. Okay, 15 minutes chart is less noisy. It will give you trades not that much as compared to 5 minutes chart. It will give you when it gives you decent trades. Okay, any other questions, or shall we end the session? Can I see your context details? Yeah, sure. You can also go on our website on ncmfinancials.com. These are our contact details. Okay. All right. So I guess we're done. No more questions are coming. If you still have questions, you can even email us. And we do have regular workshops on weekly basis for our clients in our physical offices, in our physical premises, in the NCM Institute and NORCM Academy. So once again, thank you for your participation over the weekend. And I hope we were able to deliver value today to your trading knowledge and your trading career. So let's have a great weekend. Let's have a great day ahead. Let's have a great evening. Take care and bye-bye for now. Appreciate it, Mr. Aaron. Thank you. Bye-bye.